finances, wealth, wisdom, stewardship, legacy, God's design. Get ready to learn about the gospel of finance. Let's get started.
I want to talk today about something that has been on my mind and in discussion for a couple of weeks now, talking with different individuals. I made a prior broadcast dealing with these particular areas, but I wanted to make sure that we can go back over some information, because I think that in this day and time, it is very, very important to make sure that we have the information and that it is sound and secure, so that we can use it in the best way that we know how. Talking in particular to younger individuals, as opposed to some that are older. And when I say younger, I'm talking about early 20s, mid 20s. You probably need to listen to this. Around about 30-ish, I think it's even more of importance. And primarily because we're dealing with the whole issue of retirement. And in particular, how to structure your retirement to make sure that it works for you, so that when you get old, you have something to fall back on. The challenge with people nowadays, younger people in this generation as well as other generations, is this. We oftentimes think that we have our entire lives to live. Most people, if you were like me, coming out of college, growing up, graduating from high school, the world is your oyster, was the term, or you had a mindset that we were going to conquer the entire world. Wasn't too long after that life started hitting back, punching back. And Mike Tyson said famously that everybody has a game plan until you get punched in the mouth. And this is for those who've gotten punched in the mouth, have to take a step back and regroup. So now what do I do? When it comes down to living your life, there is a structure and there is a way on how to do it. We have to make sure that we're doing it and doing it effectively. We are living, making money. In the end, you don't want to get to a place where you are working some 30 plus years of your life only to have nothing to fall back on by the time you get to retirement. So how do you set yourself up? How do you make it work, as it were? And I'm talking again to those individuals that are younger, that have a lot of flexibility, those that are more aggressive and want to put something in place, and you want to see something for you and your family down the road. Now, this applies to you whether or not you're married or single. It makes no difference. The principles of finance are principles that can only advance you if they're used properly. And when you start understanding finance, you'll recognize that finance is a discipline, not an emotion. And what I mean by that is that when you start engaging in wealth accumulation, the more you accumulate, the more disciplined you will be. And the less disciplined you are, the more you will waste. You will find excuses and reasons as to why you can spend money on the now instead of sowing money into your future so it can prepare for your arrival. So now we start looking at this. One of the major areas is this. When you look at your retirement, it's typically broken down into four different areas. And those four areas, number one, dealing with Social Security. Anybody who's working, anybody has a job, you're paying into Social Security. Now, it's not guaranteed, and the reason why I say that is because anything that is tied to the government, in my opinion, is not 100%, because this country has not been good in the area of spending and saving money. Most recent events, if you're on television, there's massive, widespread abuse in certain states, in that when you have the wrong people in office, they will spend with no regard because they have no consequence. So when we start looking at how we put money aside, you've got to take a look at, again, the Social Security, which is public insurance or public pension, is oftentimes what it's called. That's part of what we have for our retirement. The second part is, for a lot of individuals, we probably got duped into, and I say duped because I think it's just the biggest con game in the history of America, 401ks. And so you look at 401ks or 403bs for those nonprofits. Secondly, you've got your Social Security, which is another, that public insurance. The third piece you're looking at is if you're aggressive enough or progressive enough to have something by way of real estate, some type of investments that you're engaging in. Some are dibbling and dabbling in crypto. That's something that you want to take a strong look at as far as your portfolio for the future. Real estate is another area. And then lastly, which makes up, and I think should make up about 25% of your personal portfolio, at least 25% or more, is a personal private pension. Now, what is a pension? A pension is a fund that you pay money into with the express purpose of somewhere down the road that money being paid back to you with interest. Typically, it will last you the whole entirety of your life. So when you move into retirement, as an example, when you get of age, quote unquote, for Social Security, that Social Security check is with you until you die. That's a pension that is government insurance. It's the government pension that's set up to make sure that you receive a payment for the rest of your life. Now, you can actually set a pension up, a private pension up for yourself that does the exact same thing. Now, it can do more than Social Security. It can do the same as Social Security, or it can do less than Social Security. But what you want to do is you want to make sure that you have something in place that gives you a cash flow that lasts you the entirety of your life. Now, with that, what you put into it is what you're going to get out of it. Now, next question should be, okay, well, how does it set up? How do I make that happen? Well, you set it up by way of what's called an Index Universal Life policy. Index Universal Life. Now, before people jump out of their skin and say, well, that's insurance, the answer is yes, it is insurance. But it's insurance that acts sort of like a utility knife because it has multiple purposes. And the way that it was designed and set up, it was designed and set up for one thing and one thing only. It was designed for cash accumulation for the individual who has the policy. Now, you do have to qualify for it because it is insurance. But after you qualify for it, then you start paying premiums into the Index Universal Life policy. What happens is this, that money begins building. There is a portion that is going towards the purchase of the insurance because it is insurance. And there's a portion that goes into what's called a cash accumulation account. And that cash accumulation account is mirroring the stock market. So now you may not get all of the benefits of the market. So if the market goes up 25%, your cap may be 16. It may be 15, it may be 12, depends on how you set it up. But one thing that's guaranteed is if the stock market crashes, your floor is now zero, which means that you'll never lose any money based on how the crediting is done. And crediting simply says that it is they mirror the market, but they don't put your money into the market. And so as the stock market rises, your account will rise, but not all the way at the level of the stock market. But when it falls down past zero, yours doesn't go past zero because, again, you have that protection. This is what you call retirement savings. Now, you do have what they call retirement investments, and those are the 401ks, if you consider that. Other types, crypto, those are retirement investments in that there is speculation that is tied to that. Speculation simply says that there is a possibility that you can lose some or all of your money. But with your retirement savings, what you do is if you set it up right, you'll have those aggressive retirement investment accounts like your 401ks and your IRAs, things of that nature. But once you start making that money, what you want to do is begin shifting that money into your retirement savings because you want to protect that money so that when I get to retirement, I'm not losing everything, or right before I get to retirement, I should say, and the stock market corrects, I don't want to lose all that money and then have to start all over again. So I'm shifting money during the course of my life into retirement savings accounts. Annuities would be another one. IULs would be one, because these are protection for your retirement. Now, insurance by definition is financial protection against loss. Financial protection against loss. Why is that important? Because everybody uses insurance in every aspect of life. Again, I've said before in times past that if you buy a house, you gotta have insurance. You buy a car, you gotta have insurance. If you buy a dog, you gotta have insurance. And most financial institutions, banks and otherwise, use financial use insurance to protect their financial position. And so likewise, we are using insurance to protect our financial position. And that is done through the Index Universal Life. And so as you set it up, again, it is a policy that we use that is specifically designed for cash accumulation. These came online back in the early 80s. And the reason that how they came online, I should say, back in the early 80s, there was some back and forth in Congress and with the banking sector when it came down to the type of products the insurance was putting on the market. And they were using this. Now, before this, what ended up happening was most people in retirement drew their retirement from pensions, insurance product. And then from there, banking industry wanted to get in on the game. So what they did was they started developing, went through some Irish codes, and I'm giving you the 30-foot overview of actually what happened. But when it's all said and done, they came across a tax code in the regulations, and this was tax code IRS code IRC 401k, and this has been the foundation for what you know now as the 401k. The 401k was never designed as a retirement strategy. It was a tax code that was not stumbled upon, but researched and brought forth from some CPAs who were working for their company to find tax breaks for their company. So it was never designed necessarily for the individual, because the more you put into it, the more tax breaks the company that you work for gets, because they're able to defer money into different periods. But again, that's the 30-foot overview. There's a lot more to it, but you get the gist of what I'm saying. And so now as that money is shifted, they get the tax breaks. So again, it was never designed necessarily for you. You do have some benefit in that the money you put in is tax deferred. Now that works to the benefit of your company, that works to the benefit of the IRS. As a matter of fact, most 401ks are a mutual fund for. So overall with the 401ks, just know this, it's just a bad deal. It's just a bad deal. It works more for your company than it does for you. There are better ways for you to save for your retirement than 401ks. But back to the IUL, Index Universal Life. Again, I mentioned earlier, it is financial protection against loss. It's the definition for insurance. This is one of the perfect vehicles that you can use to help bridge the gap when it comes down to the Social Security, 401ks, any other type of investments if you fall short. So in piecing together your retirement, you always start, like Stephen Covey said, with the end in mind. You always begin with the end in mind. So the end is, where do I want to be? Where do I want to land in retirement? Most people want to land in retirement where they're starting or where they're making the highest income during the course of their lives. So if I'm making, for example, $50,000 a year in retirement, I'm not really trying to drop below $50,000. If I can stay at that level, that's what I'm going to do. But we have to make sure that we keep in mind taxation, because when you start looking at retirement, there are two things that come into mind that you have to make sure that are at the forefront of your retirement. And if your retirement specialist is not working on these areas, then they're not really working for you. And those two areas are this: cash flow, making sure that you have cash flow that lasts you the entirety of your life. I need to have access. It needs to be liquid to a point that if I need to put my hands on it, I can put my hands on it. It's there when I need it. And secondly, tax mitigation, which means that I'm not trying to increase my tax bracket when I'm in retirement. I'm actually trying to decrease and or eliminate my position while I'm in retirement. The Index Universal Life does these things for you because, again, it is insurance. Now, let me give you an idea of how it's designed. It is a hybrid in that you have different types of insurance. You've got term insurance, you've got hybrid, or what they call permanent insurance, and you've got whole life insurance. Whole life is the most expensive. Term is the least expensive. The permanent insurance is a combination of the two. And it is sort of in the middle of the road when it comes down to cost. And that's where your IUL lies. And again, I'm not going to go down and drill down into the details. If you want to study out more what is permanent life insurance versus term, then go ahead and take the time to do so. Permanent versus whole life, again, go ahead and take the time to do so. But using the permanent insurance, which is the Index Universal Life, it gives you the flexibility of having the insurance, which will last you from a term standpoint up to age 120, and the ability for cash flow or cash accumulation makes this the perfect vehicle, because that 25% that we're lacking when you have your 401k and after you've done your crypto or your real estate investments and you've got Social Security and I'm still not where I need to be, what bridges the gap? The personal pension or the Index Universal Life. So now, who's using this? You've got different people in our culture that are using this. People like Jim Harbaugh, Dabo Sweeney, not to get into some of these names, but just to give you an idea, Ray Kroc used cash value life insurance. Who else did we got here? You got not only him, but you got J.C. Penney is another one that used cash value life insurance to help build J.C. Penney, to help build Walt Disney World. You got Don Staley is another one who uses this from what the research has shown. So there's a lot of individuals that have brought this into the mainstream. This is not something that is simply a unicorn. This is something that is mainstream. It's something that people are using as a part of their portfolio, and you need to use it too. Now, you may not have the hundreds of thousands of dollars or millions of dollars that you can put into something like this, but you do have something. And we need to make sure that we can use that to maximize our position, because again, the use of insurance in finance is something that has been done since the beginning of time. We're the only ones this day and age now, they've talked us out of using insurance because of what people have talked people into. And again, you got some very high notable proponents or antagonists, those that are against, I should say, IUL or insurance in particular. People like Dave Ramsey. And this is something that he said out of his own mouth. So I'm not throwing shade or trying to throw him under the bus or anything along those lines, but he has a position where you should buy term and invest the difference. Now, most people that are insurance or have financial backgrounds will tell you that's probably the worst thing you can do. Because when you start looking at the term in and of itself, understand this, statistically, term policies, only 2% of term policies ever pay out. So it's just money you're throwing away. Let me say that again. Only 2% of term policies ever pay out. Now, what does that mean? That means that most people who get a term policy live longer than the term, which means that all that money I've given to the insurance company over the years, they get to keep. And so now for me, you've got to come back to the drawing board. Had a client that was talked into getting a term policy. It was $1 million term policy. It was something that he made the payments and simply forgot about it. And then when it's all said and done, guess what happens? He looks up, he's in his early 60s, and the policy terms out before he has a chance to convert or get something different. So now that $150, $165 a month premium that he was paying now balloons into several thousands of dollars because age, sickness, all those play a part in determining the payments or the premiums that you make. So now he's 30 years older and his body is not as healthy as it was. And so now the insurance is going to cost him more money. Whereas before, if he would have had something in place and set up right, he'd still be making payments. He still have the same amount of $1 million insurance. Now he has $1 million worth of insurance now. It just costs him 10 to 15 times more than he used to pay. That $150 payment that he was paying is now ballooned into several thousands of dollars for the same type of coverage, all because it was set up the wrong way. So now using this again, it can benefit you. It fills the gap. It is something that we need to make sure that we're using and looking at long term as well as short term. And lastly, the thing is this, when it comes down to setting it up, the younger you do it, the better. The older you are, the more it's going to cost you. The more money you're going to have to put into it to fill the gap. So the Index Universal Life is a valuable tool for retirement. It needs to strongly be considered. And you can use this in addition to other forms of retirement or other vehicles that you put in place. It can be the sole vehicle that you use. I do have a client that he caught it early on, decided he wanted to get into retirement savings. He worked for a nonprofit. His wife was a teacher, school teacher, and he wanted to do more. So he had the money at the time. He put $1,000 a month. This was several years ago. He put $1,000 a month, still has the policy to this day. And that $1,000 guarantees him over $100,000 a year when he gets to retirement, all of it tax-free. And so now he's not only reduced his tax position, but now the strength of his dollar carries further, because 30 years down the road, guess what's going to happen? The value of the dollar will go down, taxes will increase. You need something to help mitigate those taxes. And again, tax mitigation and cash flow, the two things that he set himself up for. Now he's in a win-win situation. And also too, he has liquid money that he can tap into for his children's education. If they want to go to school, some type of higher education by way of vocational training, they have access to money down the road for those things as well. So the IUL is a very, very important part of your retirement portfolio, and you need to make sure that it is actively being used in your retirement scenario. And if the people that are working with you in your retirement, if they're not putting this before you, if they're not able to add this to your mix, then you may want to take a look at finding somebody else, or finding somebody in addition to the people that you're working with, to make sure that all your bases are covered. So I'm hoping this helps, and I'm hoping that it sparks the interest in you to dive into understanding and learning IUL even more so, because it is, again, a very, very, very necessary part of your retirement savings and your retirement portfolio overall. So that being said, I hope I gave you some good information, and we'll see you when we see you.